Every trader thinks they understand candlestick patterns, but have you ever wondered why the same candlestick that looks like a profitable signal can sometimes trap you? Take a look at this candle. It's a bullish hammer candlestick pattern. Most traders would say it formed at a support level, so the price is about to move higher. And yes, that's exactly what most people believe. But here's the real question. What do you think smart money is seeing at this level? The reality is that 90% of retail traders see a hammer, assume it's a buy signal, and jump into the trade. Smart money knows where those traders are placing their stop losses. So instead of moving the price up immediately, they often push the price back to retest the level, trigger those stop losses, and then send the market higher. That's when retail traders are left wondering, what just happened? My analysis was right. Why did the market hit my stop loss before moving in my direction? The answer is simple. Your liquidity was swept. This is where the psychology of the 90% and the 10% becomes obvious. The 90% trade based only on the candlestick pattern. The top 10% of professional traders trade based on context, not just the pattern itself. Today I'm going to show you what retail traders never see. So if you truly want to understand candlestick patterns the way smart money does, this video is for you. First, let's understand how you should really look at candlestick patterns. Why don't candlestick patterns work without context? Which candles are designed to trap retail traders by grabbing liquidity? What confirmations should you wait for before trading a candlestick pattern? And most importantly, how do you recognize the psychology behind every candlestick? The first thing you need to understand is how to interpret any candlestick pattern. Take a close look at this chart. You'll notice a bullish engulfing candlestick pattern forming at a support level. If you had entered a buy trade based only on that bullish candle, there's a good chance you would have lost the trade. Why? Because the same bullish pattern attracted thousands of retail traders to buy at that level. Most of them also placed their stop losses just below the support. So why didn't the market move straight up after printing the bullish engulfing? Why did the price come back to retest the support first? The reason is that smart money is active around major support levels. They can create a bullish engulfing, or almost any candlestick pattern, to attract retail traders into the market. Before institutions can enter their large positions, they need liquidity, and that liquidity often comes from the stop losses of retail traders like you and me. Now take a look at this chart. Price rallied away from support, then quickly dropped back with several strong bearish candles. If you look closely, you'll notice a bullish pin bar forming right at the support level. Naturally, most retail traders see that pin bar and buy immediately. After all, the price is sitting at support, so it should move higher, right? And eventually it does, but not before smart money sweeps the liquidity. Most retail traders who bought the pin bar place their stop losses just below the support level. Those stop losses provide the liquidity institutions need to enter their large positions. Once that liquidity is available, smart money pushes the price below support, triggering those stop losses and trapping retail buyers. Now look at this point on the chart. A large bearish candle appears. A move of that size is unlikely to be driven by retail traders alone. It's often a sign of institutional activity. By printing that strong bearish candle, smart money invites sellers into the market. Retail traders see the support breaking, so they start selling and place their stop losses back above the broken support. So what happened? First, smart money trapped the buyers with the bullish pin bar. Then they attracted sellers with the large bearish candle. Now they have collected liquidity from both sides of the market, giving them enough orders to build their own positions. And once those institutional orders are filled, the market explodes higher. The lesson is simple. Don't trade what the chart appears to show at first glance. What looks obvious may actually be a smart money trap designed to fool retail traders. Whenever you spot a candlestick pattern, ask yourself, if I can see this pattern, thousands of other traders can see it too. Instead of entering immediately, wait for confirmation. Wait for the liquidity sweep. That allows you to align your trade with smart money instead of becoming their liquidity. If you keep taking random trades based only on candlestick patterns, you'll never become part of the top 10% of consistently profitable traders. Now let's move on to the second point and understand how candlestick patterns become much more accurate when combined with context. Let's break it down on the chart. This level is acting as a strong support. Both retail traders and smart money can clearly see it. Price is now sitting at support and a bullish engulfing pattern forms. What happens next? Naturally, 90% of retail traders start buying. Smart money also wants to move the price higher, but not before collecting the liquidity they need. Instead of pushing the market up immediately, smart money retests the support level and sweeps the liquidity from those retail buyers. At the same time, they create the illusion of a breakdown to attract sellers into the market. As the support appears to break, buyers are stopped out and forced to exit their positions. Now the path is clear for smart money to drive the price higher. Meanwhile, retail traders who sold the breakdown place their stop losses just above the broken support, creating even more buy-side liquidity for institutions. Once smart money has collected enough liquidity, the market takes off like a rocket. The key lesson is this: never trade a candlestick pattern by itself. Trade the context. Ask yourself, at what level did this pattern form? Are retail traders' stop losses likely to be sitting here? How many times has the market respected this support or resistance? Is the market likely to sweep the liquidity before making the real move? You can think of context as your confirmation. Never enter a trade until you have at least 2 or 3 confirmations on the chart. That simple habit is what separates the top 10% of traders from everyone else. Now let's understand the type of candles that are often created to sweep retail liquidity. Take a look at this chart. Price forms equal highs. Then, on the third attempt, it breaks above those equal highs with a strong, high-volume bullish candle. Seeing such a powerful breakout, most retail traders immediately start buying while the candle is still forming. They usually place their stop losses somewhere below that bullish candle. Now look back at the previous highs. Those equal highs contained sell-side liquidity, and that liquidity was swept when the breakout candle pushed above them. At that point, the market is filled with the stop losses of new buyers who entered the breakout trade. This is where smart money reverses the large bullish candle, sweeps the stop losses of those breakout buyers, collects the liquidity needed to fill institutional orders, and then drives the market sharply lower. So whenever you see a rejection candle forming at a key level, be extremely cautious. Smart money can use a fake breakout followed by a strong rejection candle to trap retail traders and trigger their stop losses. These rejection candles are often referred to as liquidity candles because their primary purpose is to collect liquidity before the real move begins. Now let's move on to the next point. Confirmation entry. One of the biggest mistakes traders make is seeing a bullish engulfing or pin bar and entering a trade without any confirmation. But the market doesn't move because of a single candle. Where that candle forms is what determines whether the move is real or just a trap. Imagine you spot a strong bullish candle and immediately enter a buy trade, but just above that candle is a major resistance level. What happens next? The same candle that looked like a bullish signal can quickly turn into a trap candle. This is where the concept of a reaction zone becomes important. Whenever a candlestick pattern forms, always study how price reacted around that zone, both before and after the candle. Ask yourself, did the market leave a strong rejection wick? Was there a noticeable volume spike? Did the market create a change of character, CHoCH, in the structure? These confirmations help you separate high-probability setups from traps and dramatically improve the quality of your trade entries. Now let's talk about the story inside every candlestick. Every candle is built in 3 stages: trap, manipulation, and expansion. First, the market creates a trap by showing retail traders a false direction. Next comes manipulation, where the price forms a wick and sweeps the stop losses of those traders. Finally, the market enters the expansion phase, where the real move begins. For example, look at this long bullish candle. At first glance, it looks incredibly strong, but look more closely, it formed above a major resistance level. That means smart money first attracted breakout buyers, collected their liquidity, and then drove the price sharply lower. Always remember, a candlestick doesn't tell the whole story by itself. The location, context, and liquidity behind the candle are what truly matter. And if you found this video valuable, don't forget to subscribe to the channel and hit the like button so you don't miss future trading lessons.